When most people save for retirement, the strategy seems obvious. Put as much money as possible into tax-deferred accounts like a 401k or a traditional IRA and let it grow untouched and delay paying taxes for as long as possible. On the surface, that sounds smart. After all, who wouldn't want to avoid paying the IRS today and give their money more time to compound? But here's the catch. What looks like a win in your 40s and 50s can become a serious liability in your 70s. By deferring too long, you may actually end up handing more to the IRS, not less. That's because of required minimum distributions, or RMDs. Starting at age 73, the government forces you to withdraw from your tax-deferred accounts, whether you need the money or not. And the longer you've waited, the larger those accounts have grown, and the bigger your forced withdrawals become. This isn't just a tax issue. Those RMDs can push you into higher tax brackets, make more of your Social Security taxable, and even drive up your Medicare premiums. What started out as a smart tax deferral strategy can end up backfiring, taking away your flexibility right when you need it the most. Hi, I'm Phil Gallant, president of the Optimist Group and author of Get Me to Zero. And in this video, I'm going to break down the hidden tax trap of RMDs and why waiting too long to touch your retirement accounts often backfires, and the smarter moves you can make before age 73 to stay in control. If you find this helpful, don't forget to like this video, leave me a comment, and subscribe to the channel so you don't miss future retirement strategies that could save you thousands in taxes. And if you want to see how this applies to you, book a call with me. The link is in the description below. Now, let's get into it. The first point is this: RMDs grow larger the longer you wait. Here's what most people don't realize. The longer you defer withdrawals, the bigger the account balance gets, the bigger your RMDs will be. For example, say you retire at age 65 with $1 million in a traditional IRA. If that grows at 6% annually, by the time you're 73, it's worth about $1.6 million. Your first RMD would be roughly $62,000, whether you needed that income or not. And each year after, the percentage that you're required to take only increases. That forced income often pushes retirees into higher tax brackets, undoing years of deferring that were meant to save on taxes in the first place. Here's a second issue. It's a domino effect on Social Security and Medicare. See, the trap isn't just the tax on the withdrawal itself. RMDs can create a domino effect that ripples through the rest of your retirement plan. Large withdrawals can make more of your Social Security benefits taxable. Up to 85% of your Social Security can be taxed once your income crosses certain thresholds. Now, on top of that, higher RMD income can increase your Medicare premiums through what's called IRMAA, which is the income-related monthly adjustment amount. These surcharges can easily add between $2,000 and $5,000 a year per person in extra healthcare costs. I've seen clients blindsided by this. They thought they had free Medicare at 65, only to find that their large RMDs pushed their premiums far above what they expected. Here's another issue: the lifetime tax bill is often higher. Deferring withdrawals often increases your lifetime tax bill. By the time you're in your 70s, the IRS has you exactly where it wants you, forcing large withdrawals at higher tax rates. For example, I worked with a gentleman who had nearly $2 million in tax-deferred accounts at age 73. His RMD was over $80,000, pushing him into the 32% tax bracket, add in Social Security and pension income, and his tax bill was much larger than he ever anticipated. If he had started smaller withdrawals in his 60s, combined with Roth conversions, he could have reduced his RMDs significantly and cut his lifetime tax bill by hundreds of thousands of dollars. So the lesson is, it's not about minimizing taxes this year, it's about minimizing taxes over your lifetime. You know, your tax planning window gives you control. The good news is that you don't have to fall into this trap. The years between retirement and age 73 are your tax planning window, and during this time your income may be lower because you're no longer working, but you haven't started Social Security yet, or you haven't taken RMDs. This gives you room to act strategically. You can take withdrawals on your own terms or convert portions of your IRA into a Roth. Now, by doing this, you fill up the lower tax brackets intentionally, reducing the size of your future RMDs and creating a pool of tax-free money you can use later. This isn't about paying more taxes now, it's about paying less over the course of your retirement. Here's a real-world example. So a couple I worked with retired at age 64 with about $1.5 million in tax-deferred accounts. Instead of letting it sit untouched, we created a plan where they withdrew around $60,000 a year from their IRA. Now, some of that went into Roth conversions, and some of it covered living expenses. So by the time they reached age 73, their IRA balance was closer to $1 million instead of $1.8 million. Their first RMD was cut nearly in half, which kept them in a much lower tax bracket. Now, on top of that, they had built a Roth IRA where they could access tax-free money anytime they needed. That's the difference between letting the IRS dictate your withdrawals and taking control yourself. Then there's the inherited IRA factor, which is passing on a bigger tax bill. There's one more trap that most people overlook when it comes to RMDs, and it doesn't affect you directly, it affects your family. When you pass away, whatever's left in your IRA or your 401k doesn't just disappear. It gets passed on to your beneficiaries, and thanks to the Secure Act, most non-spouse beneficiaries, like your children, are now required to withdraw the entire balance of an inherited IRA within 10 years. Here's why this is such a problem. Your kids are often in their peak earning years when they inherit. They may already be earning six figures from their own careers, and suddenly, on top of that, they're forced to take out $50,000, $60,000, $70,000, $100,000 or more each year from your retirement accounts. Now, that extra income doesn't feel like a gift, it feels more like a tax bomb. I worked with a client recently whose father left him a $900,000 IRA. Now, on paper, it looked like a blessing, but because he had to empty the account within 10 years, he was forced to take out nearly $90,000 a year on top of his salary. That pushed him into a higher tax bracket. It also increased his state taxes, and it left him frustrated because so much of what his father had worked for went straight to the IRS. This is where planning makes all the difference. Roth conversions, charitable giving strategies, or even drawing down some of those accounts earlier in retirement can significantly reduce the size of the tax burden you leave behind. Instead of passing down a problem, you can pass down flexibility, and in many cases, tax-free wealth. The key is this: RMDs aren't just about your lifetime. They're about the legacy you leave. If you don't plan, your heirs inherit not just your money, but your tax bill. So let's recap. The hidden tax trap of RMDs happens when you defer too long. By the time you reach age 73, you may be forced into larger RMDs than you need, higher taxes on Social Security, increased Medicare premiums, a larger lifetime tax bill, less flexibility with your withdrawals, and a heavier tax burden for your heirs through inherited IRAs. The bottom line is this: deferring taxes isn't always the smartest move. What feels good today, avoiding taxes, can create bigger problems tomorrow. The smarter approach is to use your tax planning window in your 60s to take control. Strategic withdrawals, Roth conversions, and careful planning can dramatically reduce your tax bill, not just for you, but for your family too. And this is where working with a financial professional can make all the difference. If you're approaching retirement and want to make sure that your tax plan is working for you and not against you, let's talk. Click the link in the description below to book a free consultation, and I'll walk you through your options. Thanks for watching, and if you found this helpful, don't forget to like, comment, and subscribe for more practical retirement strategies.